Good evening, everyone. Hope you all are doing great. Welcome to today's webinar, which is all about our PMS portfolio. It's great to see people joining in. We have 13 people in total, some new names, some no names. Welcome, everyone. My name is Simran, and I'm part of the marketing and business development team at Estee, and I would be moderating today's session. I'm excited to introduce you to our speaker, Mr. Sandeep Tyagi, who most of you would already know, so he does not really need an introduction. But he is not just our CEO, he is also a thought leader in the investment space, bringing in years of experience in the markets and this industry. Welcome, Sandeep.
Thank you, Simran. Great to be here. Welcome, everyone.
Great. So, before we dive in, let me set the stage. These monthly sessions that we do are all about connecting with you guys, keeping you all updated on how our portfolio is performing, and of course, answering your questions, any questions that you may have. So, let's start with what we have prepared for you today. Sandeep, if you can share your screen and start the presentation. Great. So, let's have a quick look on the key topics that we'll be covering today, which is on the next slide. Yeah. So we'll start with a brief introduction about Estee for the people who are new here. Then Sandeep would be taking over to talk about our portfolio's latest performance and market correction insights. Sandeep would also be covering our investment methodology in brief. In the next section, we have tried to compile some frequently asked questions from our clients that we would be covering, and we would be ending the session with the live Q&A where you can ask anything directly to Sandeep and have your doubts cleared. So please feel free to post your questions in the Q&A box, and we would be happy to take these up at the end of the session. So let's start with the presentation that we have prepared for you by introducing Estee. For those who may be newer to our PMS, Estee is a SEBI-registered portfolio management service provider. Our core strength lies in our quant-driven investment approach, where we leverage data and algorithms to make research-backed investment decisions. Our strategies are built extensively on backtesting, and we have been in this space since 2008 when SEBI permitted algo trading in India. We are currently managing an AUM of over 1,500 crores. Moving on to the next slide, to talk about a little more about our speaker. As I mentioned, Mr. Sandeep Tyagi is the chairman and CEO of Estee and founder of Good Luck, which is a retail investment advisory arm. He has done his BTech from IIT Delhi and MBA from Columbia Business School. He brings an experience of over 30 years in this industry and domain. He has recently added another feather to his cap by writing a book called The Little Book of Big Gains. For those of you who have not read the book yet, it is the perfect guide if you're just starting out with your investment journey, or even if you're a seasoned investor, it's definitely a great read. So do check the book out. He also founded Inductis, an analytics outsourcing company, which later merged with EXL Service. Now, let's talk about what everyone wants to know, which is how our portfolio has performed. I'll pass the floor to Sandeep, who will take you through the performance update of our portfolio.
Thank you, Simran. I know this is a really trying time for investors. These are the times where our emotions and the roller coaster ride that's going on in the stock market tests our resolve to be invested in the equities. Its starting point should be looking at what is the long-term view of your goals and investments. So we put in this first slide of how is the investment done since inceptions when it started in May 2019. 100 rupee invested in it over this period of more than 5 years would have resulted in 396 rupees right now, which would have been a CAGR of 26.6%, as opposed to the BSE 500 total return index, which would have taken you to 220, would have been a 14.5% CAGR. So overall, the kind of investment opportunity that has been afforded in the equities markets since the launch of this product have been fantastic. We have been doing very well, but obviously this pales in comparison to the kind of upheaval we have experienced in the last 2 to 4 months. So let's take a look at what is it that we have been experiencing. Yeah. This is the return series month by month on the product. As you can see, the last 2 months have been negative 9.8 and 9.6. Before that, in October of last year, also we had a pretty significant negative month at 8.9. So these 3 months together give us a pretty sizable drawdown, which is about the max drawdown we have ever seen of about 25.5%. Just to put this in context, this is still less than the total drawdown that has been experienced by BSE 500, which is 28.8%. The overall standard deviation of the portfolio has been 18.5%, which is very similar to the S&P numbers. But the gross returns, as I mentioned, have been significantly higher over this period of experience that we have had. Now, the market correction that we are already seeing from peak, which is roughly in September, the Nifty 100 is down 18%. Nifty Midcap is down 21%. Nifty Smallcap is down 26%. And across the board, on the weighted index basis, the Nifty 500 is down 19%. Now, since our portfolio tends to be more weighted towards mid and small cap, our correction and drawdown has been more than what the Nifty 50 would have done in this period. The breadth of the market correction is also something to, I guess, understand. If you look at number of stocks that are down 50%, one out of the top 100 stock is down 50%. 7 out of mid cap 150 are down 50%, and 34 out of the small caps are down 50%. All the way, if you look at the stocks which are down at least 10%, 91 out of the 100 Nifty stocks are down 10%. 144 out of the 150 Nifty Midcap are down 10%, and 243 out of 250 stocks out of the small cap would have been down at least 10%, which means that the correction in the market has been very, very broad and pervasive. These kinds of adjustment of overall environment is what is driving this. Now, to make this point more clear to us, we've broken this down into two parts. The overall market is a combination of earning per share and the price to earning multiple, the EPS and the PE multiple. If you look at the data for the Nifty 100, that correction has been about 18%, but it is a combination of EPS still going up, inching up in the last quarter, but the multiple coming down from 25 to 21. Now, long-term average of PE is about 22. So we are not overvalued. And if you look at where we are today, we would be fairly valued or actually even undervalued compared to what the long-term averages are. In an environment where the EPS continues to go up, this is a good sign and should give confidence to people to continue to invest. Of course, there was a bullish sentiment. There was a expectation that the markets will continue to outperform, which had given the PE a much higher number, which has moderated about 20%, 16% from its peak. If you look at the mid-cap 150, the picture is slightly different. The correction has been much more significant. And the reason for that is the contraction in the PE is much more significant. It has come down from 45 to 33. It's still quite high. If you look at the median PE number, which is about 27, a 33 number, which is where it was at the beginning of the month, is still pretty high. And that would suggest that maybe there is some more correction that may come into the market to bring these mid caps still further down. But point to note is that the EPS has still been going up. So the businesses have been doing well, maybe not as well as one would have expected, and the market expectation triggers some of the correction that you see, but it's still going up. That's not the case when you look at the data for small caps. When you look at the data for the small cap 250 stocks, the EPS has contracted by about 8% and the PE has contracted by about 19%. So the 32 multiple has come down to 26. This is now more or less appropriate because the long-term average is about 25. So you do expect a higher multiple because you're taking more risk into the product, and that's visible here. But the combination of slowdown in business as well as slowdown in the multiple has created a very large headwind for these companies which are in the small cap. Now, let's look at the drawdowns, but put it in the context of historical performance. So, as I said, these 2 months together would have been about 18% or so, which would have been more or less in line with what we have seen historically. But when we combine it with the correction that happened around October, this number becomes much larger. So, this 25% correction is much larger than 13 and 17 that we had in 20 and 22. But we've had comparable numbers before. If you look at the cone of confidence, this is something that we internally track and want to understand well. This is the active return of our strategy over and above the index. So if you look at it, we do expect that over long periods of time, we would outperform the index, which are represented by the three lines here, the orange line, the green line, and the dark blue line. Our recent actual performance has been the light blue line, which has been somewhere between expected to the bottom of what the expectation would be. So median to bottom is where the market has been performing in the recent past. And that is apparent in the results that we have. But nevertheless, the blue line is still above the orange line, which in itself is above the zero line, which means even over a period of 12, 18, 24, 36, 48, and 60 months, we would have produced a positive alpha over and above whatever has been done by the index and be able to give you a better performance over and above the index performance. This is important because the bulk of the risk and the drawdown is actually the very attribute of exposure to equity markets. Now, I would stop here just for a second, and in the book I've written about this extensively. In periods like this, people tend to gravitate towards safety, and they swear off equity markets, and they want to actually get exposure to fixed deposits or gold or even real estate, believing that these asset classes give them the safety, growth, and security that they are looking for. But if you look at the historical data, with all its ups and downs, equity markets outperform gold, fixed income, and real estate by at least 5 to 7% compounded over long periods of time. So if you're going to build wealth through your savings, it's essential that you have exposure to equities. How much exposure is an element of your asset allocation, your own confidence, your own ability to handle ups and downs in the stock market, and your own savings rates relative to your goals, which we can talk about more, but that is what one should drive your asset allocation and your ability to take these risks. Now, I want to show this chart which shares our allocation to different factors. The historical allocation to the factor in Indian market, momentum has been a very big factor that has worked well. So the purple line represents how much exposure we had in our model, in our factors to momentum. In February 2024, it was as much as high as 75%. And on average, it has been maybe around 50% or so for the last 1 year. If you look at it post-September, which was the peak, the exposure to momentum started coming down. Now, this is what should happen in a self-adjusting model, which is looking at what factors are working in the market, how to adjust your portfolio. So the exposure to momentum came down. In December, it was zero, and in February, again, it was zero. And the allocation that we had done at about 50% historically was taken away. Most of the allocation and exposure at this point is to value. And we are kind of basically tilting our portfolio more to position ourselves towards safety and value, because that's where the environment and the factor environment is right now in the portfolio. In the last 2 months, we have also had about 40% exposure to consumer discretionary, financials, and IT, which have underperformed. Now, this is not surprising. Some or the other sector would have underperformed. And as I showed you, the breadth of the correction, it's pretty widespread. The overall sentiment is off in the market. And no matter how diversified a portfolio you would have run, you would have had negative headwinds facing you across the board. Now, what should be the focus in terms of our investment journey? I think Estee, as you know, is a proponent of quantitative systematic investments. We do not believe in providing any significant guidance in terms of market timing or saying this is a good time or a bad time. We don't have a strong ability to predict what the next month is going to hold. We hold our asset allocation firm, and on a periodic basis, if your asset allocation is at a certain level, actually the periods when there are significant correction is the time period to allocate back to equity so that you can participate as part of the rebalance in the upside, which would have been the same thing maybe in July, August, September. When we were doing these things, we had said the markets have been extremely good. We have had 2 or 3 years of nearly 50% return in the stock market. And this would be a good time to rebalance where the parts of the portfolio that have run up, you sell some of it and allocate it back to your other more stable parts of the portfolio. But when they have corrected 25%, when they have actually gone down significant, whatever is your rebalance time period, at that point, you should be looking at rebalancing it across all your asset classes, and which would likely mean that you would be buying into the market as it corrects. So look, stay focused on your long-term goals, follow your systematic investment plan, and stay disciplined and avoid emotional decisions. We don't see anything fundamentally totally different. Corrections are violent, they happen. The amount of global headwind, both across US and India, given the political environment, is significant. But the Indian stock market is fairly priced, except some parts of midcap. And we believe that the basic structure of how we compute and build our models and position ourselves month on month still is the appropriate way of positioning ourselves for investments. Let me take you through a little bit of a revision on what is that methodology that we use. So our objective is to create a directional strategy which will outperform the benchmark while maintaining, volatility under control. The style is completely quantitative. We do not do any subjective overrides. Neither me nor any portfolio manager sits there, reads the news, or comes in after reading Economic Times and saying, I'm going to go to cash or do things like that. When you invest in an equity product with Estee, we are going to stay invested in that. And the asset allocation part of it is an investor decision. So, what part of your money you want to keep in fixed product, like we have an iAlpha product, which last month did over 1% in return, even when the long alpha product was down nearly 10%. That's the balance between having a fixed income type product versus an equity linked product. So that choice of how much you want to keep in equity linked product versus a arbitrage or a fixed income type product is yours to make. We do not change. Anything that you are going to invest in this fund will be exposed to the equity risks 100%. The process for us looks at the S&P 500, which means it does look at the small and mid cap. So we want to perform with the whole universe of the 500 stocks, and we look at all of them together to decide which 50 to 70 stocks we are going to take a position in on your behalf. This is not a Nifty 50 portfolio that is only going to focus on the largest 50 stocks. It looks at the top 500 stocks, including mid cap and small cap, and that's generally a good bag. Even 70 years ago, when the first quantitative analysis was done on stock markets, Pharma and French, the Nobel laureates who created a lot of the framework for these investments, identified size as one of the investment attributes. And a firm like ours, which has the quantitative capability of analyzing 500 stocks every month, is a good place to take that bet and help you generate better returns over periods of time, because we can select which of these 500 stocks is good stock to hold into our portfolio. Then we obviously do portfolio optimization. So many a times we get a question, what are your largest performing stocks? What are the stocks which have created the most losses? And while we can share that information, that's really not the way to look at portfolio performance and portfolio balancing. The portfolio works together as a group of stocks. And that's a very important aspect, because how much we put in each sector is something we control. How much we put in terms of growth stocks versus value stocks versus low volatility stocks is something that we balance out. So portfolio optimization is an important part of implementing in our strategy, which is why we do not recommend that people, kind of do partial implementation of our portfolio and say, I like these 10 stocks out of the 50 that you're doing, but I don't like the other 40. It's not possible for us to do analysis like that, because the overall portfolio optimization is part of the methodology. We look at all kinds of factors: momentum, growth, value, large cap, mid cap, small cap, or sector information, and then put that in a hopper. Today, this says we have 130 factor, but we now in our research library have nearly 800 factors. We have tested these factors across India, across Brazil, many markets, US, and we have created this library to understand what works to help predict daily, weekly, monthly, annual returns in the stock market. Those are the things that we then combine to give us the portfolio results. So the building blocks are, there are dynamic factors that we are combining. We look at the data of what is coming in and out of the index. We look at the data of what are the institutional holdings. Are mutual funds buying this stock or selling it? We look at what are the scores of the sector and the industry rotation, so that we can have a sense of which industries are in favor, which industries are now moving out of favor. And we also look at some of the market microstructure data, like what is the pricing of options, futures, cash market, what is happening in terms of the balance and imbalance between these factors, to give us a better understanding of where to take a position in a particular set of stocks. We put this together into a multi-signal library and then calibrate it based on regime estimators. So in an environment like this, where it is a risk off time period, the small and the mid cap are out of favor, people are moving out of it. The environment is such that there has been a lot of correction, will automatically gravitate the factors away from momentum, away from growth, and put more of value and quality factors into it, which is what I showed you earlier on in terms of what was happening in terms of factor weights that's going into the portfolio construction right now. Now, the different market conditions and different factors work very differently year on year. This is a patchwork quilt chart that we like to show our investors, that no single method works in every environment. So if you look at 23, 24, the best performing factor would have been momentum. It was up 21%. In 2023, it was up 42%. In 2022, it was worst performing. It was minus 5%. Volatility was doing best, and overall Nifty 50 did only 6% in 2022. So depending on the environment, the type of factors, the type of portfolio stance dramatically varies, and we try to keep adjusting. But every adjustment and the market scenario takes a little time to flow through the system to say this is what is how to position your portfolio to benefit from what is going to come or what is coming or happening in the market right now. So as of February, we don't have any momentum allocation anymore. We have more value, and we expect that that aspect of it will start balancing out the risk and reward characteristics that we will see in the market at this point. If you look at some of the questions that we typically get, Long Alpha has experienced 2 consecutive months of poor performance. Should this be a cause for concern? I showed you the historical data here. Some things like this have happened before. I agree it's not been to this extent, especially given the February's performance of another 9% down. But, over 3-4 months of period, we can end up with significant months with the down performance. Like in 2022, we had 4 months of negative performance within 5 months, and they together were resulting in about 17% drawdown because one of the months in between had a 6-7% positive performance. We've not had a positive performance for quite some time right now, which is kind of creating a further drawdown. By the way, this has to be, if you look at January and February, where we are down about 18-19%, the relative performance to index is only 7.5% because the index itself is down about 11% in these 2 months. So when you have a double jeopardy, yeah, the markets are not doing well. They are down 11% in these 2 months. And at the same time, our model is not doing very well in those 2 months. Then we get the kind of results that we are getting, that we are down 19% in these 2 months. But that's a combination of market not doing well at about 11% and our fund, our performance not doing worse by about 7.5%. To put this in context of longer period, even when the fund was not live, we have shown you some of the backtest results. So in the models that we have created, there would have been period around the COVID time period or even earlier in 16 or 13, when these periods would have come every about 18 months to 24 months, where the correction of about 20-23% have happened historically. One more question that we get sometimes is, your portfolio was supposed to be very diversified. What has led to such significant underperformance compared to both markets and peers? You're absolutely right that we do carry positions, significant number of positions in our portfolio. The largest weight we have over this period of time is only about 6%, and we have weights in many different stocks overall. But going back to the start of the presentation, where I showed you that 90+% of the stocks are down 10+% over this period of time, the correction has been so widespread that it has been nearly impossible to have not a negative performance. I think there are some managers who chose to go into cash. As a philosophy, we do not do that. We do not change our allocation from equities, because we believe that we have been retained by our investors to take equity risk, and that's what we do the best in terms of keeping them well positioned for the markets. By the way, when the periods are good, if you look at this 2020, because we were not in cash, look at the outperformance we had right after the correction. And that happens because if you are exposed to equities, when the markets turn, they'll also give you significant returns. So our view is, it's not our job to help to decide for our investors whether they should be in cash or in equities. The part they want to invest in equities, we want to do the best job possible and not mess around with the allocation to cash versus equity exposure. Yeah, this is the data on 478 out of 5 stocks are down 10% or more. 410, which is more than 80%, 82% are down 20% or more in terms of the NSE 500 stocks. So if you were exposed to equity markets, which is what this product is, there was no way to escape like a 20+% correction into your portfolio. I'll stop here. I'm sure there are lots and lots of questions, and we'll open it up to questions now.
Thank you so much, Sandeep. It was really insightful, not just, learning about our own portfolio performance, but also having a view on the market and how to stay positive during these times. So thank you for that. Uh, we will now move on to the Q&A section. So we have received a few questions. The first question is by Saurabh Mehta. What do you think will happen if Nasdaq starts declining like Nifty is right now? Do you expect Nifty to fall further? Also, do you see your equity PMS performing in that scenario? And he says that he's already an investor in our alpha PMS, and I'm considering shifting to long alpha.
Yes, Saurabhji, thank you. I don't have a strong opinion on what will happen relative to market timing. I think in several of my videos and even in generally in the book, I've kind of expressed that the ability to predict about what the markets will do next is nearly a fool's errand, and we don't really do that professionally. However, if you're following the markets, the correction in even the last 2 days have been very significant. Even today, yesterday, I think Nasdaq was down 4%. So clearly, a lot is happening in the market. And with the news around tariffs and other things, the general volatility in the market is very high. The positioning between I alpha and long alpha, as I mentioned, in aggregate, periods of bad returns are followed by periods of good returns. So there is a slight positive correlation that you can find. Now, we've had pretty lousy 4, 5, 6, 7 months already. So if I were to look at just historical data, I would say yes, you should start rebalancing and potentially, because this part of the portfolio is down so much, I alpha last year was up 12, 13%. It would make sense to rebalance and start putting money towards equities overall, just to keep your allocation at the same spot.
Thank you, Sandeep. There is another question by Mr. Saurabh. Since I've heard that you typically hold 80 to 100 stocks, would it be possible for you to create a customized higher risk portfolio for a client based solely on your momentum strategy, but again with just 30 or even 10 stocks?
Saurabh, we do have a separate concentrated product that we provide as an advisory. It's called Gulla Gear 6. It's available for investors to pursue on their own. You can subscribe to it. We will tell you what 20 stocks we believe are the best to hold. It's not a pure momentum strategy. We believe only in multi-factor strategies. We don't believe in a single factor strategy, because when we look at the results, we cannot outperform our multi-factor approach by focusing only on momentum. So we do not recommend that we do that, and we don't provide it as a service either. But we do provide a concentrated 20 stock portfolio as an advisory service as a research analyst, and that's available on our website. It's available through Small Case. It's called Gulla Gear 6, and you're welcome to subscribe to it and get access to what we think are the best stocks to hold at any given time, which is a concentrated portfolio. That concentrated portfolio was way outperforming the diversified PMS portfolio when in the bull market. It was significantly outperforming. But as expected over long periods of time, it'll also have higher risk, which is, I guess, what we are seeing going through right now.
Next question is by Mr. Venkat Raghavan. Even though you have covered this, I think it will be good to reiterate the audience who has joined a bit later. Is it time to top up? Should one wait till April?
Yes, I would not be able to precisely tell you when is the right time to top up, because the markets could correct further. They could start going up. We don't have the ability to crystal ball graze into that. We do know, as I've indicated, that bad periods are followed by periods of reasonable and good, better than expected returns. So, given that we have had very significant corrections for about 6 months now, if you have allocations to fixed income and equities, you should think about rebalancing them about now, and you can do it over next 2, 3 months, so that the emotional load of doing that bet and seeing the market correct to 3% tomorrow or day after does not bother you too much. But moving in that direction is the right thing to do.
We have another question by Mr. Venkat. How quant picks up right value stocks now, which is mainly on our investment methodology.
So as I mentioned, we have hundreds of factors that we work with, which include all the academic research that's out there. So if you were to search all the academic papers that have been written on stock market investing, you will end up with about 1,500 types of factors, which could include everything. So a typical value stock, value is measured by price to earning. Is it cheap for the amount of money it's earning? Is it cheap for the amount of cash flow it's producing? Is it cheap relative to its other peers in the same industry sector? All of these factors are codified and tracked in our model. Most of our factors are composite factors. So they may have a price element to it, momentum element to it, growth element to it. But then when we put all of it together, there are methodologies called attribution analysis, which allows us to tease how much of our portfolio construction is exposed to momentum, how much is exposed to value, to growth. So that's how we know. But we don't just say, here is a value factor, because otherwise we'll only have seven things to look at. This is momentum, this is growth, this is value, and we would have to make a decision on that. That's not what we do. We find very granular ways of categorizing each of these attributes using hundreds of these factors. And then depending on what we see happening in the market, we create a portfolio giving weight to a few hundred of these factors, which we believe are the best factors in this environment. So value factors are the same way. There is no separate process for momentum versus value versus growth. It's just looking at a slew of factors, which typically would be called value factors, and seeing if they would have given us a good return in this market environment.
Next question is by Mr. Vijay Rao. Any learning since October that warrants tweaking model to better cope with drawdowns? The portfolio volatility seems to be higher, especially when index is going down.
Yes, the stock has historically had a beta which is very close to 1, but we do notice that in the last few months, the beta of the portfolio has gone up. It's almost 1.2. We've been trying to bring it back. We have been increasing the number of model factors that we are giving weight to. So as part of our research process over the last several months, we have been increasing the number of factors we give weight to. So we believe in diversification and multi-factor approach to investments, and not just banking heavily on a few things or one thing that works. So these are some of our observations. The market teaches you something new every day. So you're right that the beta recently in the last 6 to 12 months has been higher than long-term historical average that we have, which is around 1. And we are trying to bring it down through exposure to multiple factors.
The next question is, going forward, do you see the great performance of long alpha being averaging out or outperforming the benchmark in 5 years period?
We believe that historical patterns establish what would happen with methodology. So we certainly expect that there would be outperformance. The kind of outperformance we had in the last 3-4 years, where we were outperforming the index by 20-25%, I think were extraordinary outperformance. The performance right now, where we are underperforming by, say, 7-10%, is also quite high. But I think in aggregate, if we continue to outperform the index by somewhere around 5 to 8%, we would consider it to be a very significant achievement, because over long periods of time, those kinds of outperformance are very, very meaningful.
The same person has asked if we can comment on accuracy of the models used for momentum strategy in specific.
Momentum is, momentum is one of the easiest factors to build. And even NSE publishes a momentum index, so you can very easily see what are the stocks in momentum. But momentum is not a be all end all. If I show you the data um, of when momentum works, which I was actually showing you a little bit. So momentum has worked as number one or number two in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 9. 9 out of 12 years, momentum has been either number one or number two. But it has also been last in one and second last in two of those years. So we believe that a multi-factor model is a better approach than a single factor momentum model.
Next question is by Mr. Thomas. Since
By
they
the
were
way,
late in,
Simran, just 1 second.
yeah.
If you look at the performance of single factor funds, and there are many, many factor funds which focus solely on momentum, uh, I would not be surprised if they had a really bad last 4 or 5 months. And it's not their fault. When you are a single factor model, you'll do extremely well when the momentum is working, but then the risk is also much higher. And we try to control it, and we try to take the advantage proportionate to the risk that it is generating in our portfolio. So it's not like we are not exposed to momentum, but we are exposed to momentum maybe 50, 60% of the time rather than all the time 100%.
Yeah, so as I was saying, the next question is by Mr. Thomas. Since they were late in joining, they want us to discuss drawdown and rebound analysis, potential rebound given our expectations, India internals, and geopolitical trends.
Yeah, we are quant investors. So we do not really provide a lot of guidance around macro factors and what we understand is happening at a macro level. We don't have that as part of our investment process. We believe that all of these macro factors, including geopolitical risks, are factored into the pricing information that we see in the stock market every day. So if the collective wisdom of the stock market was that there is tremendous geopolitical risk, it will show up in the stock market price in terms of correcting it in the next day. And then we will factor it in with the relative understanding of where is it impacting more, where is it impacting less. So two things. One, we are looking at the markets and individual 500 stocks individually and then collectively relative to each other. So when we say out of these 500 stocks, we are going to have position in these 70 stocks, not have a position in these 430 stocks. Effectively, what we are saying is these 70 stocks are better positioned than the remaining 430 stocks to weather the risks that are there in front of us. So I won't be able to give you a lot of commentary and color around macroeconomic and geopolitical risks. My expertise in that area is what I would call dinner conversation that you may have with a friend or a colleague. This is not something we provide professionally.
The next question is again by Mr. Vijay Rao. Considering rebalance happens monthly, how can you quickly adapt to new learnings and get feedback on your changes?
The speed of learning is not even monthly. It's actually much slower. The adjustment to portfolio can be much faster than monthly. And over time, we have tested time and time again, is it better for us to have a capability of adjusting the portfolio, let's say on a daily basis, on a weekly basis? And what we have found is that even though we can score the portfolio daily or even multiple times a day, the cost of adjusting the portfolio on every change in information does not pay off at a frequency much less than a monthly rebalance. Now, some people would say, why would you wait for the end of the month if I already know that the stock is, falling a lot? Like IndusInd is down 27% today. Why would I have it in my portfolio? The reason for that is unless you're a high frequency trader and you're doing market making, there is no way for you to react to the information in real time because the stock is already down 27%. Now, can anybody tell me would IndusInd tomorrow be up or down? It could correct tomorrow back up 10%, or it could go further down 10% from where it is. But we don't have any specific additional information today to say just because it dropped 27% today, it's a bad or a good stock. So we do not believe in over trading the portfolio on a real time basis. Over long periods of testing, we have determined that for large portfolios and holding, a monthly balance periodicity is appropriate, which balances the transaction costs with the alpha that we can extract out of the information that is available in the market.
So the next question is by Mr. Anand. For additional investments in next 3 months, please advise if it should be done in long alpha or Gullak your 6 small case.
Anand, that would depend completely on your risk and operational appetite. The difference between Gullak and long alpha are multifold. Number one, in Gullak Gear 6, the execution responsibility lies with the investor. So once a month, we give you a model portfolio and we recommend to you what to buy, what to sell. But you send those orders to your own brokerage company and they execute it by sending it to the market. So generally, the slippage on those portfolios tends to be higher. On the other hand, in long alpha, when we determine what to buy and sell, we use algorithmic execution capabilities to execute that using pretty cutting edge execution algorithms. And we measure the exact slippage. So our slippage is only few basis points in terms of getting in and out of a position. What we are buying and selling does not overall create a lot of difference from the pricing that we are looking at. So that's an important difference. Who does the execution? The second aspect, as I mentioned, is Gullak Gear 6 takes position in about 20 stocks. So it's much more concentrated than PMS Long Alpha, which takes position in about 50 to 70 stocks. It's much more diversified. Both are looking at BSE 500 universe, but one is taking a concentrated bet on about 20 stocks. The other is taking a bet on about 70 stocks. The third difference in this case is you obviously have the ability to tweak what you're doing. So if you are an active investor, and even though we wouldn't recommend doing this at all, but you do have the ability because we are providing you the model portfolio and you choose what you're going to execute or what you're going to do. In PMS, it's discretionary on us. So we, as the manager, execute on your behalf and we do the whole portfolio management for you. So these are the differences. Over long periods of time, I fully expect that long alpha will perform better risk adjusted than Gullak Gear 6. But during significantly long periods of time when the markets are conducive, Gullak Gear 6 will be a fantastic product and will do very well.
There are no more open questions, so I would urge the audience if they have any more questions. Okay, so we received another one by Mr. Anand. What is the difference in performance in last 2 months between long alpha and Gullak Gear 6?
I know the long alpha returns because I just reviewed them. Let me ask the team if they can pull up the Gullak performance for last 2 months and provide that information.
I've asked the team to provide us the data. In the meantime, if anybody has any more questions, yeah, so we have a question by Mr. Pankaj. How to handle Japan's situation, decades of no returns? What should we, our strategy as a retail investor? Should we keep SIPs, buy on dips, or how should we approach it?
Yeah, I think that's a very perceptive question that over long periods of time, we do assume that equity markets will produce good average returns. In general, that is true over very long periods of time, maybe over an investing life period of 30, 40 years. That will be true because Japan has had stagflation and no returns for about 20 years. But before that, it had tremendous returns for 20 years before that. Um, the broad view of the overall Indian economy is very bullish right now. If you, even though we do not look at the macro factors in day-to-day analysis, but it's well known where we are in GDP growth. It's well known where we are in terms of our fiscal prudence, inflation, overall government expenditure, the demographic dividend, in terms of the overall tailwinds to the companies which serve within the Indian markets. There is a very strong positive likelihood that we'll continue to do well. Now, how do you avoid getting stuck in a situation where equities just do not have uh, any kind of meaningful growth? Well, you'd have to look at the EPS growth, even though there may not. See, stock market is not magical. It's got combination of two things. What is the earnings that the companies are producing, and what is the multiple that the market is giving to it? The earnings is something which it doesn't change day to day, doesn't change month to month. The multiple does change a lot. As I just showed you in the data, most of the volatility comes because the multiple, because the emotional um, value of the same amount of business is very different based on the optimism or pessimism of the investor. So I would urge you to look at the earnings growth. And if the earnings growth in the country slows down dramatically or starts going negative, then I'd be much more cautious. Doesn't matter whether you're a bullish market or a bearish market, but be difficult to keep growing any market if the earnings are not increasing uh, in line with what the stock market is supposed to be doing, which is, by the way, not the case in India. India earnings have been growing. They haven't grown as much as we had expected towards the last quarter end, but overall, they have been growing very nicely.
The next question is by Mr. Venkat. Do you recommend small lot top up or bulk?
There is plenty of research which says that there is no financial benefit of doing, stepwise investments. The question is, where are you keeping that money while you're waiting to invest? If you are allocating from some other investment to into this investment, then step by step investment is a good idea because you're rebalancing portfolio over time. So, for example, if you had I alpha or fixed deposit and long alpha, and you said, I'm going to take, I'm going to go from an allocation which is 50-50 right now to 70-30, 70% in equities over the next 6 months. So, every month I'm going to do 5%. Yes, good strategy to do. But if you're keeping that in simple cash account and say, I'm just timing the market, then the likelihood that your timing is going to produce any value is very, very low, actually negative. Most of the time, the expectation of stock market return is positive. So if the expectation of stock market return is positive for you over and above your other alternatives, so the longer you stay out of the market, the lesser returns you are likely to make. Now, if anybody had the ability to say tomorrow is going to be down 2%, so let me wait 2 days and then day after I'll put that in, yeah, great. But I don't know of anybody who can do that with any level of precision.
So we have received the monthly return from the team for Good Luck Year 6. As on Jan end, which was 31st Jan 2025, it was -6% compared to -4% in NSE 500. And as on 28th Feb, it was -10.20% compared to -7.9% in NSE 500.
So 11 and 6, is that what it is for 2 months?
10 and 6, yeah.
10 and 6. So it's about 16% down. PMS is down about 18%. So Gulla Gear 6 has done a little better over these 2 months, is, I guess, what the conclusion is.
So the next question is by Mr. Pankaj. SEBI was going to introduce some instrument for 25 lakhs investment as an alternative of PMS. What was it? Do you offer that?
SEBI has notified what is called SIF, which is a special fund, which will have a minimum investment of 10 lakhs. It's not operational yet, but it can be offered by people who have an AMC, which is they can offer a mutual fund. Those people can offer this particular product. It's an alternative to PMS and AIF. The special thing about that would be it will be allowed to take derivative positions. It will be allowed to take a leverage as well. So we expect that market will meet the needs of people who are looking for more sophisticated long short type of strategies or derivative strategies. We do not currently have the ability to offer that product. However, we are filing to get an AMC, and at some point we should be able to offer that, maybe once we are approved for it.
The next question is by Mr. Satwar on Gulag Gear 6, asking if the portfolio has 15 or 20 stocks because the latest portfolio they see 15.
So it's in that range. It's quite possible that in the last rebalance they've reached to 15, but I think the average is about 20, and we try to keep it at about 20 to have it diversified.
With the latest portfolio change, it was actually set at 15 only. And in the past, it has actually increased to 20 as well, as mentioned by Sandeep.
Okay.
Mr. Shiva is asking, what is the tax liabilities for I alpha and long alpha products?
The tax liability for I alpha is business income. It has two components: derivative trading income as well as interest income. So we break that out for you, and you report it on your own tax returns under those two heads. In long alpha, it is generally going to be short-term capital gain tax. There are very few pieces or securities which will be held beyond a year. Most of it will churn during the year. So you will be paying short-term capital gains tax, which is 20%.
Mr. Shiva is asking, what is the tax liabilities for I alpha and long alpha products? I think we've covered that. So next question is by Mr. Hari. Sir, I've invested in IFB Industries at price 2390 and now it is down 46%. Kindly guide what to do in this stock.
Hariji, I won't be able to help on a specific stock recommendation, not because I don't want to help you, but that's just not something that we can do very well. As I mentioned to you, we do not have any view on an individual stock. We look at the portfolio of stocks, and I don't actually know top of my mind if IFB is something that we have a position in or not. So won't be able to help you there.
Mr. Anand is asking, what is the latest AUM of Estee Long Alpha PMS for retail investors?
Yeah, so across the retail and the PMS product, it'll be about 600 crores.
Mr. Pankaj is asking, since Good Luck doesn't offer hedging, is it worth to learn on our own and implement in separately? What do investors like Ramdeo, Agarwal, etc. do? They have unlimited money to average out, but we don't. Is staying invested and being patient the best strategy?
Yes, market timing is not a good idea. It is generally always delayed. It chases the market performance. There is a very interesting case study that I have in my book. There is a fund called Magellan Fund, which was run by a gentleman named Peter Lynch. For 25 years, the fund produced on average return of 26%. However, the average investor in the fund lost money. And the reason for that was typically people would come in after 1 or 2 years of spectacular performance and leave right after there was a big drawdown. So they ended up coming in when the performance was very good and leaving when the performance was very down. So the combination result of this is that even though the fund did very well over a long period of time, the average investor did not. I would strongly urge you to do your research, bet after your research on two, three, four managers who can advise you on your portfolio, and then allocate money to them and do not touch it for some period of time. Maybe 2, 3 years is a good period to evaluate how performance is working. And that will give you an ability to look through the performance through cycles and then decide whether this is something you can do or not. If you keep adjusting allocations on a monthly basis, I think it is very likely that you're going to be underperforming the markets. Actually, on a lighter note, they did an analysis on who are the best performing investors. The second best performing investor group was widowed and single women, and turns out they do not touch their portfolios for a very long period of time. And the best performing cohort were dead people who were absolutely not touching their portfolio. So I say that in jest, but I think frequent performance tracking or chasing is a short way of underperforming the markets.
That's very interesting to know. We have also heard cases where people just forget that they invested their money sometimes, and after long periods of time, they come to know how much their portfolio has grown and get lucky. So next question is by Mr. Vijay. The other SEBI product you mentioned that's similar to mutual fund, that sounds really interesting because of derivatives and also possibly shielding from taxes to be reported as an investor, especially if I plan to hold this for 5 years. And they are saying that please count me in.
I think that would be the idea. I think mutual fund industry was feeling that the alternative platforms which are allowed to take positions in this are able to offer products which the mutual fund industry is not. So SEBI has come up with this structure which is in between structure. It has a minimum investment to protect from everybody trying to jump into this. So 10 lakh minimum, but it allows you to create some more sophisticated products than a simple long only fund.
The next question is by Mr. Anand. Do we have any plans in near future to have in-person investor meet in Mumbai?
Um, I am not, but if there is a lot of interest, we'd be happy to do that. We do occasionally do in-person meets, and please put comments like that on our website or on our uh, um, LinkedIn page or on our Instagram page, so that we can track if there is interest. We'll be happy to do that.
Actually, last year, Vivek visited to Mumbai and had a small investor meet there and met a lot of investors in person as well. He shared this communication with all our leads and clients, and it was great to have, a few people show up and actually interact with Vivek Sharma, who's the investment head. And we do keep having these events, so it's basis on how you request these, and if you want it to happen in Mumbai, we'll surely plan something around it. Next question is by Mr. Pankaj. Will the strategy of rebalancing Good Luck Year 6 on need basis rather than on a fixed monthly rebalance date as it is currently be more advantageous? This is a question for Good Luck.
Particularly in Gullak, we don't think that's a good idea because the execution is in the hand of the individual investor. So for thousands of people to track if a rebalance has come and then to act on it on a timely basis will be very unlikely. And we think that will create more slippage and divergence in their performance if we were to do it on kind of like sporadic basis. Now, some people say, well, why do we need to rebalance if there is nothing changing? That's true. And that would show up if the scores reflected that the existing portfolio was the best portfolio possible, then we would not be giving any trades out. But we don't see that. We do see that over a month, enough change has happened that rebalancing something does provide enough value that we can overcome the cost of trading to give you a better result.
Mr. Hari Gopal is asking, sir, how PMS is better than mutual fund as both have more than 40 shares? Would it be better if concentrated portfolio is maintained?
Um, mutual fund is certainly a better tax vehicle to do this. The only benefit a PMS can have is because the taxation is at the individual level and the individual holding level, we can offset some of the losses and gains against each other and give you a better treatment that way. But overall, I think over long periods of time, unless you are doing some more customized strategies like we do with I alpha or we do with long alpha with mutual fund, we also give people exposure to international funds through, a way of creating a balanced portfolio. Then mutual fund is tax advantageous product. That's why we are trying to build a mutual fund platform as well.
Mr. Pankaj is agreeing with your story that true, my wife's portfolio is giving better returns than mine. Nice to see you, sir. It would be great to see you more often.
Happy to do this.
Uh, Next, so Shiva has also put up a request to have a meetup in Bangalore as it's overdue since long. So we haven't done anything in Bangalore, but definitely we can plan something in a few cities if we see that that's the response that we're getting. Next question is, unfortunately, I bought into long alpha in September 24, and as of today, my portfolio is down significantly. I would need to see close to 32% upside just to break even. Thank you for this presentation and advice to continue to stay invested. Can we have more sessions like this?
So we do a kind of monthly rebalance seminar where we share what's going on. Usually my colleagues Simran and Vivek do that. And we'd be happy to, we're always happy to answer any questions. We encourage people to put those questions on any of our LinkedIn pages or social media, and we'd be happy to answer any questions that you may have.
Next question is, what steps should I take if I want to invest in PMS? What is the time for onboarding and due diligence process?
So you're welcome to reach out to us on any of the links that we provide. I think on our website we have the link and email addresses, and I see somebody's typing in maybe the email right now. The onboarding process is online, especially for individual investors, so we can completely get you onboarded online with us. You get your KYC and other things done. So if you have a Aadhaar-based KYC already done, eKYC done, then it'll be faster, and we'll be happy to get that process done pretty quickly with you.
And we have already noted down the details, so we'll get in touch with you shortly, sir. Mr. Vijay Rao says, monthly rebalance seminar. How can I be notified about that? Since you have logged into our seminar this time, we have received your input on the form as well. You would be receiving the notification on email and WhatsApp next time, and you can definitely join this session. So those were all the questions. I would just request the audience if they have any more questions, we'd be happy to take those. I think that's about it, Sandeep. Thank you so much for joining. There's a thanks from the audience as well for you, Sandeep. Uh, and thank you everyone for joining. Hope you have a good night. See you next time. Bye.
Bye. Take care.